There's only one thing better than finding that perfect dividend stock with a high yield. Even better is when it takes the risk out of your portfolio and puts that cash in your pocket every single month. In this video, I'll show you why every investor needs monthly dividend funds in their portfolio and how to find them. Then I'll reveal the 7 best monthly dividend ETFs for high yields and returns. We're talking monthly dividend funds today on Let's Talk Money.
Beat that.
Make money.
Make your money work for you.
Creating the financial future you deserve.
Let's talk money.
Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, we talked about monthly dividend stocks last week and the video was immediately one of the most popular ever. I mean, who doesn't like getting paid every single month for holding a stock? And we looked at the best out there with yields of 8 and even 10%. But one of the biggest problems with monthly stocks, the issue that we talked about in that video, is that risk in having all your money in just a few business types. Since most monthly dividend stocks are either in REITs, that's real estate investment trusts, or BDCs, business development corporations, just investing in these sets your portfolio up for a nasty surprise when that economy comes down on the group. That's why I just had to follow that video up with this one, and an idea that's going to give you the chance to keep collecting those monthly dividend payments, but also lower the risk in your investments. You're going to be able to keep that cash flow and know that that dividend is going to be there when you need it. So in this video, I'm going to show you how to add those monthly dividend funds to your portfolio and how to find the best monthly payers out there. Then I'm going to reveal the 7 monthly dividend ETFs that I have in my portfolio. Now, one of the best things about these monthly dividend funds is they're going to give you a chance to diversify your portfolio into these other assets and stocks. And because most dividend stocks don't pay on a monthly basis, so if you're just looking for that constant cash flow, you're really limited to those few business types, those REITs and those BDCs. Not only does it make it for an extremely risky portfolio, but there are a lot of great investments out there that you don't benefit from. But with these dividend funds that we'll talk about, they invest in different assets like preferred shares and stocks. Even the ones that don't pay on the monthly basis, the fund can take all this cash flow and pay it out regularly to investors. So we're going to look at those 7 great dividend ETFs, but I want to do more than just tell you which funds to buy. Those of you in the nation know this channel isn't about just throwing a stock list at you. I want to give you the tools to be a better investor, know how to pick these investments for yourself. And when you're looking at adding funds, it all starts with the gaps in your portfolio. Where are the gaps in your stocks or the assets that you already own? For example, if you own only stocks, then you might want to look for some bond funds or real estate ETFs to give you exposure into those asset classes. If you get more growth from your stocks, but the dividend yield is a little low, maybe you look for some of those funds with the higher yield to give you that instant cash flow. So now, after you've got an idea of what you need in your portfolio, I want to look at 2 factors when investing in these dividend funds. And most dividend investors are going to go straight to that dividend yield on the fund, but I want you to also look at a chart of the stock price and build that into your decision. Because in that last video, we looked at another one of those problems with monthly payers, a falling stock price. It does absolutely no good to collect that 12% dividend yield if the stock price falls so much that it just wipes out your return when you sell. Here you also want to look at the expense ratio on the funds. That's the annual percentage fee charged on the fund assets. Now the fund deducts this from the assets. You don't really see it come out of your account, but it still has the same effect of lowering that fund value. Now the best ETFs, those from Vanguard, Fidelity, some of those other names, they're going to have expense ratios under 0.25%, which is really just $2.50 for every 1,000 invested. Now, a lot of these monthly dividend funds are actively managed, and the fund might be using some alternative assets to produce that higher yield, so most here are going to charge higher expense ratios than, say, Fidelity or Vanguard. That said, I still wouldn't pay more than about 1% for any fund I buy. Nation, this is extremely important, okay? Especially for those closed-end funds that you're going to find that they're promising dividend yields of like 12 and 15%. Against those huge yields, most investors don't even think to question a 2% expense ratio, but then wonder why their portfolio never really goes anywhere. And it's because the only ones getting rich on these funds is the manager collecting that high expense ratio. That said, let's look at my 7 favorite monthly dividend funds, all low-cost ETFs that I own and that pay every single month. I'm starting off here with a couple of dividend stock funds and the Global X Super Dividend ETF, ticker SDIV. This fund holds 100 of the highest dividend-paying stocks globally and produces an astounding 12% annual yield. The expense ratio is 0.6%, which is higher than most of these here, but there's still a lot that I like about this one. The monthly dividend has come down a little this year as companies cut or postpone their payments, but it's a well-diversified fund across different industries and internationally. I especially like the exposure to stocks in other countries here, which is something that most investors are really lacking. Stocks held in the fund sport an average price to earnings ratio of just 10.3 times, a factor of so many being shares of those cheaper international companies. It's less than half the PE ratio on US stocks, so this is a good value play as well as for that dividend yield. The Invesco S&P 500 High Dividend Low Volatility ETF, ticker SPHD, is a favorite among investors and pays a 5.6% yield. This is a great overall dividend stock ETF because it's combining that search for those higher yields with a lower risk profile and some of those with lower volatility. Now, the fund invests in 50 stocks of US companies with that high dividend yields that also have historically been safer than others. It's a little more concentrated in a few sectors, including real estate, utilities, financials, and staples, but those just tend to be less volatile than some of the economically sensitive stocks. Dividends have held up surprisingly well on this one, probably due to the fact that the companies are less sensitive to the economy. The dividend payment has increased more than 50% over the last 5 years, from just 0.094 cents to 15 cents a share over the last month. The expense ratio is lower on this one, at just 0.3%, and I think there's still some good upside price potential on the shares besides that dividend. The iShares Morningstar Multi-Asset Income Fund, ticker IYLD, is a really interesting opportunity, and not just for its 6% dividend yield. So instead of investing directly in those stocks or bonds, this fund is a fund of funds. It holds 10 income funds across the asset classes. So you can see here, it's got high-yield bonds, international stocks, it invests in emerging market debt and U.S. Treasury bonds, as well as real estate and preferred shares. The fund has a target of 60% in bonds, 20% in stocks, and then 20% in alternative income investments. It also holds about 45% of the portfolio in international assets, so very strong diversification here. The large weighting in bonds gives it that high level of safety, though it still holds enough in these other assets and the sectors for a good total return. Now, the drawback here is because this is a fund of funds, the expense ratio is going to be a little bit higher at 0.6% annually. You're essentially paying the expense ratios of all these funds in the portfolio plus the management to run this fund. So actually, if you wanted a cheaper way to do this, you could just invest in these original funds in the same weightings and maybe cut out the 0.2% on your expenses. Now, I want you to notice the dividend yields here aren't like those highest paying dividend stocks that we saw in that prior video. In fact, the next fund I'm going to show you pays a yield of just 2.9%. So I know you're thinking, why would we ever invest in these if we can get those yields of 8 and 10% on the stocks? What I like about these funds is they give you that exposure to those other assets like the preferred shares, the bonds, and the low volatility stocks. They give you that opportunity to still collect a monthly dividend paycheck, but not be stuck in just a few investments like the REITs and the BDCs. The best strategy here is going to be using a combination of the two. And getting that higher yield from the dividend stocks and then balancing it out with a few of these monthly dividend funds, which even on the lower risk, they still pay a pretty solid dividend yield. This next fund, the SPDR Bloomberg Barclays Convertible Securities ETF, ticker CWB, has the lowest dividend yield at just 2.9%, but also offers one of the best for total return potential. Look at a chart of the shares over the last year, a 20% return that's more than double the 9.6% return on stocks in the S&P 500. Now, how it does this, the fund invests in corporate bonds with an average coupon of 2.5%, and that's where you get the dividend yield. But these bonds are also convertible into shares of stock if the stock price increases. That means investors get all the safety and the cash flow of those bonds, but the upside potential on the stocks. The fund holds 243 bonds across mostly industrial, utility, and financial sectors, with the biggest holdings including Tesla, Wells Fargo, and Carnival. The dividend payment has come down a little bit on this one as those interest rates decrease and the bonds yield less, but that total return still makes it a great addition, and the expense ratio of 0.4% isn't the worst we've seen. The iShares Preferred and Income Securities ETF, ticker PFF, is a similar theme and pays a higher yield of 5.7%. Preferred shares are another mix between those bonds and stocks. They receive a fixed payment that must be paid before shareholder dividends, so they tend to be less volatile compared to stocks, but they also include some ownership appreciation like those equities. And this is a part of the market that most investors neglect, so it's really nice seeing a fund that gives you an easy one-stop access to it. The PFF holds 512 preferred securities with an average price to earnings ratio of just 9.5 times, which again is about half the market average. The fund price also tends to be about half as volatile as the stock market, so definitely that idea of safety and cash flow. This one is pretty heavily weighted to the financial sector, with about 54% in banks, diversified financials, and insurance, just because that's the sector that tends to issue this type of preferred shares the most. The expense ratio of 0.46% is a little high, but the dividend payment here is one of the most stable. Now, I also want to add a couple of bond funds here, and our first is the Spider Barclays High Yield Bond ETF, ticker JNK. The name is a little misleading here. Bonds rated below that triple B are called non-investment grade or junk bonds. They're higher risk than those investment grade bonds, the ones higher up in the credit ratings, but the default rate here is still just 2.2%, so still very much safer than stocks and a great dividend yield of 5.8% on this fund. The fund holds over 1,000 bonds and is well diversified across sectors, so even though these are those lower rated bonds, you've still got the safety of being spread across the economy. Dividends have been fairly consistent even through the last few months, and the expense ratio of 0.4% is still relatively low. For bond funds, I also like the Vanguard Long-Term Index ETF, that's ticker BLV, and even though this one only pays a 3% dividend, this is about as safe as you can get. More than 40% of the 2,500 plus bonds in this fund are U.S. Treasuries, and the rest are all investment grade rated, which has a default rate of less than 1%. Now, surprisingly, for an ultra-safe bond fund, this one has still produced a 7.8% total return annually over the last decade, and the beauty here is its 0.05% expense ratio. That's fees of just 50 cents for every $1,000 invested, so basically nothing. So if you've got a lot of high-risk stocks in your portfolio, this BLV is a great fund to smooth out your portfolio risk while still making sure it produces that monthly dividend return. Click on the video to the right for the 7 best monthly dividend stocks, 7 monthly payers with the highest yields. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.